Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host, Shafiq Morton. As always, it's great to be with you. In today's show, we are going to discuss something called investment diversification and the strategies that a person uses while investing. To put it simply, one doesn't put all of one's eggs in one's basket, but you put different eggs in different baskets to make your investment grow and to be resilient against the buffeting of what happens in our times. But to help us to discuss the nuts and bolts of investment diversification are Daniel King and Hassan Motola. Gentlemen, assalamu alaikum. Welcome to the show.
Wa alaikum assalam wa rahmatullah.
Daniel, I'm going to start off with you. Can you give us a basic definition of what do we mean by investment diversification?
Investment diversification means you're investing in a wide range of underlying instruments rather than a concentrated exposure to a low number of instruments. So as you said, simply put, it's about not putting all your eggs into a single basket, but to diversify across a number of baskets. At Oasis, we actually differentiate between 5 different levels of diversification. Including geographical diversification, currency diversification, then you have your asset class diversification, your sectoral diversification, which is the different sectors of the economy, and your actual instrument diversification, which is the most granular level at the bottom, the number of instruments that you're invested in. So to just briefly go through these on a very broad level, firstly starting with the highest level, geographic and currency diversification. Geographic diversification essentially entails investing across a wide range of geographies across the world. So, for example, if you hold a global investment, then a portion of your aggregate portfolio will be held in a country in assets that have no geographical exposure to your country of residence, for example. This process of investing in a global fund could also give you access to a range of different sectors that may not be available in your local investment market as well. Another benefit of that is that it usually comes with a degree of global currency diversification, because foreign economies operate in different currencies, so you can get exposures to currencies like the US dollar, the euro, the British pound, and through that you would not be as susceptible to the fluctuations in any specific currency, because you've got various currencies offsetting each other in their performances, and you would also be not as susceptible to fluctuations in your own domestic currency. Similarly, along a very similar line, you can make use of what we call asset class diversification. So asset classes comprise your different kinds of asset types. So equities being one, ownership of a company, for example, property-related assets, ownership of properties, and then fixed income assets like sukuk, which have more of a predictable kind of income profile. On a level below that, employ what we call sectoral diversification. So that within each asset class, you could actually get exposures to various sectors of any economy. So for example, the telecommunications sector, or the mining sector, or the manufacturing sector, they all have very different dynamics within the economy and all have very different dynamics within the investment landscape. And then lastly, within that, you have your most granular form of investment diversification, which is your instrument diversification across specific companies or issuers of financial instruments like governments across the world. So these are the basic ways in which diversification can be achieved, and these are the basic ways that we deliver diversification to our clients.
Now, Hassan, Daniel has given us the whole landscape, as it were, in great detail. Sure. Give us the why. Why do we need to diversify our investments?
I think it's always too good to step back, understand, as you highlighted, why the need for diversification. Investors, essentially speaking, face 2 important risks over time in terms of investments. One is volatility risk. The risk of losing money is the second one. So volatility is obviously how volatile a certain investment may be, so either on the upside or on the downside. But very importantly, capital risk, the risk of losing all your money is the second one. And sort of a third one I also want to highlight, and it's an important one from a long-term perspective, is inflation. So the risk of inflation eating away at wealth over a period of time. So those are 3 key aspects of it. Now, Either, if you don't diversify across various asset classes, you could be exposed to any elements of those risks. And one key aspect, I use one example, many people may be risk averse. So they'll say, well, and focusing largely on the risk of capital loss. Because they in their minds, they're thinking, I do not want to lose. I've worked hard for this money, 100,000 rands I've saved. I worked very hard for it. I don't want to lose it. So I want to keep it under the mattress or keep it in a bank account. And I know in the bank account, I want to keep it, that capital is there. The risk is always that the bank goes bankrupt, and you obviously have this stand to lose quite a bit of that. But yes, my capital is there, and I'm maybe earning a little bit on that. However, then you're exposing yourself to other risks such as inflation risk. Have you addressed the inflation risk, where inflation will eat away at your wealth over a period of time? By diversifying across different types of assets, Daniel's highlighted like geography, currency, assets. Assets is very important in the sense that assets or different forms of assets address the inflation risk. Equities has shown over time, if you look at history in South Africa and globally, over 15, 20, 25, 30 years, equities has been one of the best asset classes in terms of delivering returns relative to inflation. Look at South Africa, the Aussie, just being in the Aussie itself in the 20 and 25 years has given you fantastic returns relative to inflation. Similarly, property. Property has been a very good asset class over 20, 25 years. So those two asset classes in particular have been very, very good protectors of one's wealth against inflation over time. So they should make up a part of your portfolio and part of the whole diversification process. So equity, property, and then comes income. Now, income is a combination of longer term income and, Daniel highlighted, for example, sukuks or Islamic bonds, which are more your medium and longer term nature. And then you've got your shorter term nature, which will be your murabaha type of, or in Islamic deposits, will be your more shorter term nature. Now, also a combination of that and a mix of those type of assets will obviously sort of help in diversifying the portfolio and help to achieve a real return over the long term as well. So diversification is important from that perspective to address the risks around inflation, to address the risks around capital loss, and to address volatility risk. Now, I'm going to spend a little bit of time just understanding this whole issue around volatility, because many clients and many people out there do get concern around volatility in markets. Yes, markets will tend to be volatile. Most recently we had in the last year, we had two key events to highlight. We had Nenegate in December, and this year we had the Brexit globally. During those two periods, markets were volatile. You saw in December, currency markets were volatile, income markets were volatile, and equity markets came under pressure. During Brexit earlier this year, you had also equity markets globally came under pressure, and in South Africa during that period came under pressure. Yes, there will be volatile markets. And we've seen in the last 19, 20 years that Oasis has been operating, there have been massive events. The global financial crisis in 2007, 2008. Prior to that, you had the 9/11, you had the dot-com bubble, you had the 1998 financial crisis in Asia, various events. Yes, you've had those events here, but through those events and through those last 19, 20 years, equities have done very well. Property has done really well. The Crescent Equity Fund, alhamdulillah, it's now got a very, very long track record. During all those periods, has delivered in excess of 20% per annum to investors over that period of time. Taking all those factors into account, all those financial crises into account. So yes, you are going to have volatile markets, and it can impact during short periods of time. But the importance of diversification and the importance of having those asset classes in your portfolio ensures that you are protected, that your capital gets protected, and very importantly, your real wealth is protected over a period of time.
Now, Daniel, very quickly, Hassan has said that diversification obviously improves your risk to reward ratio. In practical terms, in the long term, how have you seen this benefiting clients?
Exactly. I think that's an important point because I believe that Oasis is one of the best proponents of effective diversification strategies. And you can see that in the risk-return profile of our funds, especially across things like our balanced funds, where you get the maximum level of diversification across all 5 forms of diversification. So just recently, for example, we received notification that the Oasis Crescent Global Low Equity Balanced Fund received the award for the Mixed Asset Fund of the Year at the 2016 Global Fund Awards. So that's on the global side, and that fund's also received 2 Lipper Awards, one in the UK, one in Switzerland over the last year. And I'm happy to say that it's available to South African investors through the recently launched Oasis Crescent International Balanced Low Equity Feeder Fund. So that gives South African investors the opportunity to benefit from maximum levels of diversification and really benefit from the strong risk-adjusted returns that can be provided through those kinds of funds. I think further evidence of the Oasis offering in terms of diversification is given in the performance of our funds, especially a fund like the Oasis Crescent Equity Fund. So even as markets have been volatile over the last 2 years, you've seen that Oasis funds consistently provide our clients with downside protection, strong downside protection relative to the peer group. So the example I gave about the Oasis Crescent Equity Fund, that fund during a typical, what you would call a bear month, where the market is down for the month, has actually outperformed its peer group by 1.2% during the average bear month. Whereas during your bull month or the month when the market is up, it delivers a competitive return with the peer group. So there's a huge downside protection differential that compounds massively over time to generate the outperformance on a cumulative basis over the last almost 2 decades. So that's really allowed us to provide a consistent return to our investors, and it's one of the main driving forces of that long-term generation of real wealth, we believe.
Hassan, to get back to you, let's have a look at how do we diversify our investments. What are the real nuts and bolts of it? I know you're keen to talk about this.
Sure. I think very importantly, Shafiq, Daniel highlighted earlier, you went through quite a few aspects. So you talked about geography, currency, instrument, asset class, and sector. One, I think, very important aspect to highlight, and I think especially from a South African perspective, is to understand, are we appropriately diversified from a local and international perspective? I think it's important because when you look at those key parameters that Daniel highlighted earlier, international actually addresses many of those 5 aspects. Geography, currency, sector, instrument, asset class. In fact, it addresses all of that. And why is it important for South Africans to ensure that they have an appropriate level of it? Now, we as South Africans, we are allowed, in terms of offshore, international, we're allowed to take a fair amount out of South Africa as an individual. You're allowed to take firstly your R1 million that you can take out per annum, and you're also allowed to take another 10 million rands per annum in terms of taking money offshore and investing offshore. So you're given, effectively speaking, 11 million rands per year that you can take outside. The second point, how you're allowed to take our money, is via a feeder fund. Now, Daniel highlighted we had recently launched the International Low Equity Balanced Feeder Fund. That's one method. You've got the International Property Feeder Fund. We've got the International Equity Feeder Fund. Those are feeder funds where you don't have to take money offshore. All you're doing is basically taking your rands here, putting it into a feeder fund and getting the offshore exposure via a feeder fund. That's a fantastic way of doing it through the feeder funds as well. And then obviously, thirdly, if you do already have money offshore. Now, many South Africans that are either or have worked overseas, many South Africans have been working in the Middle East, in London and the like, have worked there, earned money there, and have kept it in bank accounts. So they've kept it in bank accounts there, but have they been earning an adequate return on that? So that's, I think, one aspect I would like to address in terms of if you got your money offshore, or you've already taken money. Many South Africans over the last 10, 15, 20 years have been taking money offshore. Have they put it in appropriate investments that are sitting in there? So offshore diversification is important. Now, if you look at, for example, balance funds in South Africa, you're allowed in terms of Regulation 28 and the legislation where you can take 25% of your assets offshore. Now, as a South African in your portfolio, when you're sitting back, you're sitting back say, okay, this is my portfolio of investments. I've got my house, I've got money in my pension fund, and I've got my savings for me and my family. In my savings for me and my family, do I have it? Where do I have it? Is it all in South Africa? Am I appropriately diversified in terms of South Africa and offshore? South Africa, alhamdulillah, we know we're living in a fantastic country. The long-term outlook for our country, inshallah, will continue to be good, and it will be a fantastic country longer term. We've prospered since democracy and may we continue to prosper in the years to come, inshallah. So we've got a very good long-term outlook. But it's important to diversify. Look, there are short-term headwinds that we are facing. Growth has slowed in the country. There are some challenges that we are facing and which we need to go through, and longer term we will continue to prosper and be good. But it's important to diversify and ensure that from an international perspective we have appropriate, because internationally if you look at it, the global economy is growing a lot faster than South Africa at this point in time. In fact, Daniels, you can sort of confirm with me as well, global economic growth is about 3.5%, or is expected to be about 3.5% or around that levels for the year ahead. So, and South Africa is expected to be between 0.1 and 0.5% for this year, and maybe 1 to 1.5% in 2017. So our growth in the shorter term is a lot. So to benefit from that, we need to invest offshore or internationally. So therefore, when we're sitting with our financial planner saying, okay, are we appropriately diversified from an international perspective? And if you are not, important to take advantage of that. We've seen recently the Rand has been strengthening. Look, the Rand in Nenegate went up all the way to, I think, 16 Rand or so, somewhere around against the US dollar. It's come back now all the way, I think as of this morning, it's trading at 13 Rand 60 to the dollar. Look, it could maybe even strengthen a little bit further as well. But I think it's with the recent strengthening the Rand against the dollar, against the pound, against the euro, it does create, I think, an opportunity for investors to maybe say, okay, if I don't have international diversification, now is the time maybe to start building up our international exposure and get our diversification to international assets. And I think very importantly, getting diversification to appropriate assets, equity, property, income. Now you can do it very effectively through the balance fund. And this recent balance fund that's been launched, the feeder fund, it's a fantastic way for clients and investors out there to get that level of diversification internationally.
Right, Daniel, explain further the relationship between diversity and, in fact, volatility, two big words in our discussion.
I think essentially speaking, diversification, the primary purpose is as a curb on the effects of market volatility. So when markets are more volatile than usual, a typical investment manager will look to increase the level of diversification in their fund so that they can maintain a relatively consistent risk-return ratio and some consistency in performance over the long term. So we believe that that's quite a strong reason for making use of the services of an investment manager like Oasis as a retail investor through the use of a collective investment scheme in particular, because that is effectively what we deliver to our clients on a day-to-day basis, is optimizing the risk-return profile of our portfolios on behalf of our clients and delivering long-term sustainable returns that can beat market volatility, that can beat inflation. Because most often an individual doesn't really have the capacity, sufficient time to constantly re-evaluate, their underlying portfolio. That's not to say that they should not be re-evaluating their life circumstances, as they go through the different life stages in consultation with a financial advisor. But really the nuts and bolts of your underlying portfolio should rather be left to the expertise of a skilled investment manager in our view. And that's essentially what we deliver to our clients over the long term.
You mentioned the word revaluation. If I'm in a collective scheme, is there a need for me from time to time to reevaluate my position?
From year to year, it's probably best to reevaluate your financial circumstances. Employment conditions might change, your family conditions might change. As you go through your different life stages, there's different expenses that you need to take care of. Obviously, when you're younger and you're starting a family, things like your first house, your first car, education expenses are more important. When you're retiring, those things are less important. So definitely with the help of a financial advisor, we often recommend that clients reevaluate their life circumstances and make sure that whatever fund they're invested in is appropriately suited to their risk appetite and their long-term needs.
And Hassan, finally tell us about the Sharia-compliant funds that have provided this platform of diversification for your clients.
Your balanced funds are the appropriate measure for diversification. So both from a local perspective, you've got the local balanced funds that are around. They're obviously giving you well diversification across various forms of asset classes, instruments and the like. And you're still getting also offshore exposure within those balanced funds as well. Very importantly, as just highlighted by Daniel just now, is that addressing also different risk profiles. So somebody is close to retirement and the like, the lower equity funds will be better. Somebody is obviously starting off in their careers and the life, the high equity funds will be more suited to them. Very importantly though as well, and I reiterate this, I think from an international perspective, it's important to have diversification internationally. You're getting exposure to faster growing economies, you're getting exposure to different currencies and the like, which gives you that level of protection when there are times of volatility and uncertainty that may be taking place domestically. You get that benefit offshore. So, feeder funds into the balanced low equity feeder fund globally, great assets. Or if you do want to take money offshore, speak to your financial planner, go through that process. It's as you indicated, it's you are allowed to take up to 11 million rand per year. You can take it out, or you can also use your rands within the feeder funds and take advantage of that. I think also those listeners and viewers out there that have money already offshore, or actually may have many relatives and friends that are working in the UK, working in the Middle East, and really don't know how to sort of take advantage of growing their wealth, because many of them are working hard there, they're saving money, but they sort of leaving it in a bank account. And if you look at what your income yields are in many, you're earning very, very little. Here's an opportunity to sort of invest that hard-earned funds and actually really grow in hard currency for you over the long term as well.
Hassan Motola and Daniel King, thanks for chatting to us.
Thank you, Shafiq.
And that concludes this edition of the Oasis Focus and Finance Show, during which we discussed diversification of investments. Special thanks to our guests, Hassan Motola and Daniel King. Should you wish to watch this or any of our other shows, you can log in to the Oasis Crescent YouTube channel. Should you wish to contact Oasis, you can call 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm Shafiq Morton. Assalamu alaikum wa rahmatullah.